Good morning, everyone, and welcome to our webinar. This is Courtney, the Marketing Coordinator here at AIM. Today's webinar will be recorded and later posted on our website. This does mean that all attendees will be automatically muted so that we can get a quality recording. If you have any questions, feel free to type them into the chat box and we'll try to answer them throughout the presentation. But if we're unable to get to all the questions, we'll have a member of our marketing team reach out to you individually to make sure we get those answered. We do have webinars every Wednesday morning, so keep your eye on your email for the next invite coming your way. Our newest agent resource, the 2-Minute Minute, is still in full swing. The marketing team is bringing you quick ways to talk to more prospects, write more business, and grow your agency. We're posting new videos every week, so check out our social media pages, Facebook, LinkedIn, Instagram, and YouTube to see what you might have missed. And with that, I'm going to go ahead and hand this over to Derek so that we can get started this morning. Go ahead and take it away, Derek.
Thank you, as always, Courtney. As Courtney said, everyone, this is Derek here with AIM. Today, we are going to be talking about Life Insurance 101. So, should be a pretty good kind of higher level. We'll get into the weeds on some of the more specific products at another day as kind of like a 200 level class. But hopefully, there's some good information, whether you've been selling life insurance forever or you're looking to get into it or just brand new. So, the first thing is there's a lot of different life products out there, right? There's whole life, there's UL, IUL, final expense, term, return of premium term, and guaranteed issue, and many more. So a lot of agents kind of get a little bit overwhelmed with all the different products, or they'll kind of have one or two go-tos that they always stick with. Usually term because it's pretty simple, easy to sell, right? But we'll go through a bunch of these different kind of options and when and where and some of the pros and cons. One thing we won't touch too much on is going to be guaranteed issue. There are a couple final expense products that we have that do have guaranteed issue from ages 50 to 80. However, I know guaranteed issue is kind of the big buzzword going around the life insurance industry if you can find it. I know it's becoming more popular. But even when I worked for companies that we had a good product suite full of guaranteed issue products, it was something that honestly I steered most clients away from, because when they're really looking at it, there's only one rate class, right? A lot of people are going to be overpaying. And when you sit down and talk with them and explain the simple fact that they're going to be saving a lot of money over the lifetime of that product, if they just take, 5 minutes to answer some health questions or maybe 30 minutes to get, the medical interview, they're usually okay with that. And the other nice thing is it kind of helps those products stay a little bit stickier or, in place, because a lot of people don't want to go out and re-answer medical questions. They don't want to go out and have another medical interview. So they're going to keep that policy in force with you a little bit longer. So the retention on those policies and keeping that customer is a lot better when it's not a guaranteed issue, right? Because then they may just jump to another one next year that's a slightly better rate. So they are out there. I know it's kind of becoming, the big go-to for everybody, but it's something that's more of really kind of just a backup scenario that you should use, even if you have them available. So that's part of the reason we're not going to get into that today. But we're going to start this off with, the simplest product there is that you would have available to yourself, which is going to be a term policy. Some of this information is going to be a little bit, lower level like I talked about, but when we're talking about terms and you guys have all taken, your testing, you're all licensed agents, but it's going to be some kind of policy that's set for a specific term length, number of years, whether that's 10, 15, 20, 30. Those are kind of the most common. And then after that, that policy can kind of do whatever it wants when it comes to the premium, and we'll touch on that a little bit more here in a second. But to the right is an example, right? It's going to have fewer underwriting questions, right? It's going to be a lot cheaper premium. You're going to get a lot bigger benefit for what you're paying into it for most people, right? Because the insurance company is making its money by crunching the numbers and basically saying, hey, this insured who I named Test, good name, but he's a 35-year-old male. He's preferred plus non-tobacco. It's a 30-year term. They're basically looking at this and saying, hey, this guy's probably not going to pass away. There's a really good shot, right? And they're making their money off of getting that premium of $487 a year for 30 years, and they're going to keep that and walk away with it, because this is a use it or lose it, right? If someone does not pass away, it is not going to pay out. So that's one thing that's kind of there for a lot of people. And it's why sometimes you run into objections depending on certain faiths and religions where they see that they can't get into life insurance because it's a gamble, right? Because this may or may not pay out. Now, one way around that is getting into permanent life later, which we'll touch on, because that's not a gamble. It's gonna pay out for sure one way or another, right? But there are certain things that you'll run into that are going to be certain objections or issues, and knowing what they are is a good way to get around it. Term policies are going to be really good for covering large amounts over a specific period of time. So with that, they're going to be kind of great mortgage protection, or if there's a large amount of debt, or if someone's a primary breadwinner and their spouse is stay at home and they have a couple young kids and they're worried about kind of covering expenses until those kids are old enough to take care of themselves a little bit more. And by that I mean maybe get to school on the bus by themselves, come home, not have to have childcare, things like that. So terms are going to be a simple go-to. They're going to be really great. However, a lot of times I like to mix and match terms with permanent life insurance, and we'll get kind of into that as well. So that's going to be kind of your main go-to. It's going to be the number one life insurance policy that most people write because it is so simple and easy to just put out there, right? Another option when it comes to terms is return of premium. So it's going to be basically the same thing we were just talking about, right? But as you notice, the premium jumped up quite a bit, right? They're paying $165 a month, and some change for the same death benefit. The reason for that is kind of like we talked about. Anytime there's more of a risk for an insurance company to pay out, they're going to have a higher premium on something, right? So with this, while they may not be paying out on that death benefit, they're going to be giving back all the premium that the person has paid into it. So one thing I like to tell people when I talk about this with is, and it's kind of a joke, but I like to tell them it's basically a bad savings plan, right? And what I mean by that is instead of taking your money and sticking it in the savings account and earning some interest on it, right? And it's not going to be much because it's a savings account, right? But it's there, it's safe. Instead of that interest on the cash, what they're getting is the death benefit. So if something does happen to them, right, that money that they pay into this over 30 years, which is about 60,000, just under, is going to turn into $300,000. That's a pretty good return, no matter who you're talking to, no matter how much they're investing, right? That's a good return on the money. And if nothing happens, right, it's not use it or lose it. So they're going to get, as you can kind of see down on that lower middle portion, just under $60,000 that's going to come back to them. And that's a pretty good chunk of change, right? I mean, that can buy you a car, right? Maybe not 30 years from now. We'll see what happens. But it's something that you can use, or a down payment on a house. Or in this case, this person's going to be 65, right? Maybe he wants to go travel or do whatever he wants with that money. And that's a good chunk of change that he can count on getting, unless he passes away, that he can use for whatever he wants, right? And with this being a term, it's still going to be really good for, mortgages, large amounts of debt. This is going to appeal to people who are a little bit more well off when it comes to money because the premiums are higher, and they'll see a little bit more value in getting some kind of return back. So it's a really good thing to kind of keep in your back pocket. Not a lot of carriers have this, and it's something that when I've been places that do have it, sells pretty well. And honestly, if it's a younger person, like in their 20s, the premium isn't going to be that bad, right? And you can always go for a shorter term, which is going to lower the premium. So there's a lot of different ways you can kind of use these, and they're a really good tool to have. Another thing to kind of point out on these terms is they're going to be set in stone for whatever the term length you choose, right? And after that, in this case, 30 years when this person's 65, that premium can do basically whatever it wants. And usually that means it's going to start going up. Sometimes it's going to jump up quite a bit. So I usually like to have the talk with clients that, that's a possibility. And like I said, I like to bundle with permanent quite a bit. The reason for that is I've personally seen with my mother who had a 30-year term, and once she hit her 60s, she wasn't eligible to get any other life insurance. So she had to keep what she had in place with the term, even though the rates kept jumping up and jumping up and jumping up. right? So that's a possibility of something that can happen to people down the road. Or best case, they're going to have to go out because they'll probably still want some kind of life insurance in place and get a new policy at age 65 with whatever their health is at that point, right? And it's probably going to be quite a bit more expensive than it would have been otherwise. So that's a talk I really like to have with clients and just kind of show, hey, this is a great policy. It covers a lot, but it may not be taking care of everything they actually want it to, right? So keeping that in mind really helps. Getting a little bit more complex when it comes to life insurance is going to be whole life or final expense. Basically the same thing. You know, pretty much every final expense out there is going to be a whole life. It's only going to go up to around maybe 50,000 for death benefit, like it does in this case. In this case, we did a 55-year-old age male who's going to be inside of that guaranteed issue for certain carriers, like I said, age 50 to 80. So that's kind of nice. They don't have to worry about getting turned down. There's not going to be tons of, questions to go through that they have to worry about, whatever their health is. But it's going to be a lot lower benefit. And also the premium, while still, doable, is going to be a little bit higher because we're talking about kind of an older age demographic. So with that's going to come those higher prices, kind of like I was just talking about. Another nice thing with these is they are permanent, right? They're always going to be there as long as you pay them and keep them in force. They're not going to go up in premium, right? So it's locked in. That's, a very nice benefit to people that they look at. And like I said, they're going to be a little bit smaller benefits, especially on the final expense side. Part of the reason why a lot of companies are going away from whole life or pushing away from it is some of the options we're going to talk about later are just becoming a lot more popular and flexible, and people are going to that. But there are still some out there, and it's just a nice kind of fixed, rate of accumulation that they're getting on their cash value. One thing a lot of even agents ask is when they look at this, especially like year one, there's not any cash value, right? And a lot of the clients are going to be like, hey, I'm paying $166 a month. Why is there no cash value year one? Well, part of the reason is in order to keep a level premium, most insurance companies are kind of overcharging in those first years and they're undercharging in those later years, right? So those, first 5 years, maybe the amount needed to actually keep the policy in force versus the risk is, $60. And by age 75, when they're crunching the numbers, that policy would be about $320 to keep in force, right? So they're kind of just splitting it down the middle. There's going to be some overpaying in the beginning as far as what's actually keeping the policy in force, and it's not building much cash value. So they're kind of front loading that, and they're going to be underpaying later, which is why the cash value starts to build up. Another nice feature with these, depending on the carrier, right, is there's going to be cash value, so they can always just close it out, do whatever they want. At age 75, there's about $21,000 in there. If they were just like, you know what, I don't need this policy anymore, I'm going to close it out, right? And they're going to get some of that cash, or all of it if they just close it out versus borrowing. And it's going to be a nice little chunk that they can do whatever they want with. Or if something does happen to them, they're going to have that death benefit of $50,000. So it's a really good policy. It's a really good way to make sure people can cover those final expenses, like a funeral, burial, different things like that. So that's kind of a really good one to keep in mind. Another option, and like I said, this is going to get into a little bit more of the complex side. Universal life and index universal life, or IULs, is something that a lot of agents don't really dive into too deeply, right? It is something that you can make as simple or as complicated as you want. They are extremely flexible as far as how you can create them, how you can build them. I have used them for things as simple as just covering life insurance and having a permanent life insurance with the possibility of a little bit better, cash accumulation than a whole life. I have built them as college saving plans for kids, and this is going to kind of vary depending on the carrier and the state laws, right? But it's one of those things where, you might be thinking, well, why not just start a college savings plan, right? Well, with this, is something they can use if they don't go to college. It's something they can keep in place as life insurance if they want. It's something they can use to buy a car if they end up not going to school. It's something they can use for trade school or whatever the case is. And if they do go to college, it's something that's not going to go against what they qualify for when it comes to getting their student loans, whereas a college savings plan is. Another thing that's really popular with these is having them kind of mimic an annuity, right? But you're going to be getting the tax advantages of it being a life insurance policy as long as you build it the right way and explain it the right way. You can have limited pay into these to where they're only going to pay for 10 years. And then, if they want to retire that age, most people don't want to pay into these policies. It's something where they can start withdrawing from it and borrowing money. Um, so there's a lot of flexibility with how you can build the policy. Like I said, you can make it as simple or as complicated as you want. I mean, it's also really flexible when it comes to payments, right? Just because, like in this case, it says $136.12 a month doesn't necessarily mean you have to pay that, right? You can pay more if you're trying to build more cash value, and we'll get into that in a little bit. Or let's say someone gets laid off, right, and they can't afford those payments, right? If there's some cash value in there, they can use that to fund the policy for a while. Now, obviously, it's not going to grow at the same kind of illustration numbers that were shown, but it's something that's there that kind of helps keep that flexibility for the product and why it's becoming so popular. Just like whole life, right? Permanent life insurance, it's going to pay out one day. There's never going to be any premium increases, which is a great thing. You can get a lot larger benefits than you can when it comes to final expense. Now, obviously, the higher the benefit, the more money you're going to be paying into the premium. But it's one of those things that's always going to be there, right? Also, there is a ton of riders and accelerated benefits and things that are worked into these or that you can add that just further increase that flexibility. One popular one, especially up here in Washington with kind of that mandated state tax we had, is adding on the long-term care rider, right? Is it going to be as amazing as just a traditional long-term care rider when it comes to paying benefits for long-term care? No, but it's going to cover a lot. It's going to meet the need of most people. And it's one of those things where, like I said, it opens up a little bit more options for everyone who's looking and what they're looking for, right? So there's a lot you can do with these. There's also some hybrid stuff that we didn't get into, and I have touched on that in some other webinars, but if you have questions, feel free to ask me, where they're a lot more long-term care based, right? Some of those are going to be whole life policies with some really robust long-term care benefits as well. So there's a lot of different options when it comes to life insurance and what you can do and use. And I'm going to jump into a little bit of these illustrations. So this is going to once again be test, right? A 35-year-old male. The death benefit's $350,000, and it's $136.12 a month. Okay. This is going to be more of just a true, permanent life focused, example. With it, there's a few things you're really going to want to cover and get to know if you're going to start jumping into this world. So most agents and customers who have a bad opinion about ULs or IULs are thinking of the older policies that they sold or bought, 30, 20 years ago that didn't have a guaranteed floor. So what happened is these people were looking at illustrations, and as we've all known, regulations when it comes to insurance of what we're allowed to show and talk about has gotten a lot more stringent over the years. So they have to be very careful about what they show, and they have to show kind of as much as possible. But when people went out and bought these, they were looking at these values that weren't guaranteed, but it may not have been, shown the best that it wasn't. And they were looking at these huge numbers and these huge returns, and it looked amazing. And what happened with kind of downturns in the market is if we're talking about an IUL index universal life, it's going to reflect what's going on, right? In the S&P 500 or wherever you're allocating that money. So years that there was, 0% or negative percent even, right? These policies didn't grow the way they thought they were going to. The nice thing with pretty much any carrier now, and you're going to want to double check, but there's going to be a floor, right? In this case, it's 0%, okay? But there is a floor. They're never going to get that negative return when it comes to what's growing. Um, the other nice thing with illustrations like this and why you want to get familiar with them is there's three columns, right? The far left is going to be the guaranteed. The middle is going to be that alternate scale non-guaranteed. In this case, it's at 3.25%. One thing to kind of note with that, a lot of times that's going to be really their safe number, right? It's going to be what their whole lives are paying out at. It's going to be something that in some cases they do guarantee, like on the whole life, but for this, they don't want to have to if they don't have to, right? So it's a pretty safe number, okay? And on the far right, at 5.51%, this is what this has actually been growing at over the last 15, 20 years. It is something that, while obviously it's not a guarantee and you never want to say that, that they have actually been paying and growing at, right? That's included the recession, that's included COVID, right? All these downturns in the market that everybody thought was just going to crash everything, all that's included, right? And that doesn't mean it's going to pay 5.51%, right? One year it might pay zero, the next it might pay 11, right? But one nice thing when it comes to life insurance is people are a little bit more flexible with that versus when it comes to actually investing in the market because they're not, in most cases, planning on having to take that cash out on a certain year because they know they're going to retire in 2026 and they need all that money available, right? So it's one of those things where they're a little bit more okay with that. And when they look at these versus whole life, they're seeing the kind of, that there is a chance to get a better return. Normally, when I talk about this with clients, what I tell them is, like I told you guys, this far right column is what it's actually been growing at. That doesn't mean it's going to stay there, but this is kind of a reflection of what it's actually been doing. The middle column, that alternate scale, is going to be more of the safe bet kind of, not best case scenario, right? And a lot of agents and a lot of people are going to say, well, what about the guaranteed side, right? Because as you guys can see, as you start hitting, year 16, 17 of the policy, that surrender value, the cash value starts going down, right? The policy kind of starts cannibalizing itself because it hasn't been getting enough return from the S&P to keep that in force. And normally what I tell people is if we ever have our market and our economy paying 0% for 20 years in this case, or even for 3 years, right? We're going to have a lot more problems going on, right? The US dollar is going to be basically worthless if we are that bad off as an economy. So that's something that's probably never going to happen. That is going to be the absolute worst case scenario where everything in this country is just falling apart and we, are basically going into default, right? More than likely, you're probably going to be somewhere between that middle and the far right scale as far as the columns, right? And obviously, you don't want to guarantee anything, like I said, don't get yourself in trouble, but it's just talking about kind of the reality of what's going on and what's there and why it's a good idea to familiarize yourself with these columns, be able to talk about them. Another thing that's pretty common that comes up is you can see those first 5 years, no matter what column you're talking about, there's no surrender value, right? Even though they're paying in about $1,600, annually, there's nothing there. Part of that, like I said, is because that's going towards funding the life insurance itself. They're kind of overcharging in the beginning, right? To make sure that policy gets funded. After that, there's cash value. And I'm not going to go too far into the weeds on this because we could talk for 2 hours literally about just this. I've done it with agents before. But it's one of those things where as that cash value starts to build, they can borrow from it, right? They can cash it out. There's just a lot of different flexibility there. But those are some things I wanted to at least highlight on a higher level so you kind of know about them. You know what questions to ask if that pops up, right? And like I said, we're always here to help out and go through stuff. So this next example is going to be same age, same person, right? Same rating class, same death benefit, but you're going to notice that it is for $1,700, right, per month. Now you might be asking yourself, why would you go from 136.12 to paying almost $1,700 a month for the same benefit? This is going to be more of an investment focused kind of option, like I was talking about. You're going to have certain clients, especially if they are a little bit more wealthy, who are looking for some of those tax advantages, who are worried about, leaving a legacy, who are worried about, different things that are going to happen when they're passing on their money or handing it down to whoever it is. In a lot of cases, when this happens, they're going to have a lawyer, they're going to have an accountant, they're going to have a financial advisor, and they'll be on board with this because they're going to see the benefit of it, and they're going to leave usually these to a trust, and that's going to get divvied out to kind of really help with those tax advantages. Or it's going to be more of an annuity based option, right? Where they're hoping that they're going to be able to borrow from this and still get those tax advantages versus putting it into just an annuity or just other investments or other retirement funds. Um, it's going to be a really nice thing. And as you can see here, these, surrender values are going to be growing a lot faster than the other option. This is going to be, depending on who you talk to, either a TAMRA 7 pay or what some people refer to as, you know, keeping it from turning into a modified endowment contract or a MEC. And all that means is if you are putting too much money too quickly into a life insurance policy based off of what the benefit is, right? The government wants their money. They're going to look at this and say, okay, if you put more than this 21,000 in over 7 years, right? It's not life insurance anymore. It's an investment, and they're going to tax it appropriately when you go to take that money out. So that's something we can get into and talk about more and learning if you're building it the right way, if that's what you're trying to do. Because this is really appealing to, like I said, a lot of those people who are making more money and trying to get around certain taxes. And it is a really good payout for you as well when it comes to commissions, right? Um, but basically, in this case, they're paying in a lot bigger chunk of money per month, right? Over 7 years, as you can see on that far left side. And then they're paying a little bit in, 8, 9, 10, 11, right? And then after that, they're really not paying anything else in, right? They're done. They're only going to pay 151,978 into this. And it's going to keep growing, even if they don't touch it, right? But in most cases, what a lot of people do is, let's say he retires at age 55, even though he's only put 151 grand into it, there's $319,000 in there for cash surrender value that they can start borrowing from and using as an annuity. And what most people do in that case is they just keep borrowing and borrowing until the policy cannibalizes itself and closes out because there's nothing left in there to fund it, right? Because they didn't care about the life insurance. They cared about those tax advantages of getting some kind of income, right? That's going to be more advantageous when it comes to tax. Um, the other thing you're going to notice on this one, because the cash value is growing so much, the death benefit also starts to increase, right? So either way, they're getting a pretty healthy return. I mean, that 319,000 off of 151 over 20 years, right? You could go into the market and invest it better, but there's going to be a little bit more risk, right? Because there's not going to be a floor. But if they do pass away and they get 564,000, right, to leave to someone, that is a great return. That is going to be very hard to beat versus what they paid into it. So it's one of those things that are going to appeal to people when they're looking at what's going on and what they're actually getting in return. So keeping that in mind is just really important. Um, so a lot of you guys might be asking, okay, so how do we decide what we're supposed to use, what we're supposed to pitch, right? A lot of people go, like I said, with terms because it's more of that cookie cutter approach. It's really easy to just fit it in there and make it work for whoever. It's a, enticing premium because they're so cheap. But I really, if you've ever talked to me, like going on a case by case basis. I like trying to get as much information as I can. Don't be scared to get a little bit personal and find out what they're making, what their spouse does for work, how much they're making, if they're staying at home, if they have kids, if they want to have kids soon, if they just bought a house, if they're planning on buying a house, right? How much debt they have. So that way you can actually not only really service the client in the correct way, but you can give them different policies and options that are going to fit what they actually need. Because a lot of people know they need life insurance, they just don't really know what kind of life insurance, right? They're going off of social media and they're seeing all these different ads and things about, oh, get term and this and that. And when you have those conversations, right, you're going to be setting yourself up as that professional. They're going to keep coming back to you for more things down the road. Okay. So some places I work call them simple conversations. Some call them fact finding. It helps if you have an outline of certain questions that you want to get to. But the goal is to try and lead them to, once you figure out what they really need, to get to that conclusion by themselves with kind of leading questions. And it's going to make selling it a lot easier, especially once you go to pitch what you have. And for example, right, let's say you have a single male, age 22, college grad. Most people are just going to pitch a term. That's all they're going to do. But it's not a bad idea, kind of like we talked about, to look at a permanent life insurance solution with what they're going to be earning. Because one thing I didn't really get into is even that cheaper premium of 136 a month for an IUL, they can put more into it later if they're making good money, as long as they don't turn it into a mech, because then they're going to lose all those tax advantages and be getting a better return on it, right? Be probably having a healthier, death benefit, right? There's a lot of different options, as well as adding, um, guaranteed increases and stuff like that they can take advantage of with those, and it's going to still be in their price range. So don't, like I said, just get stuck in a rut. Don't be scared to kind of explore some of these other options. And if you're not sure what to do, give us a call. That's what we're here for. Another example, married male, primary breadwinner, wife stays at home because they got two new kids, 1 and 3. They just bought a new house, right? This is going to be one of those times where I would definitely try and pitch both a term and some kind of permanent life insurance, right? Let's say they feel like they need $1 million in coverage. Okay, do 750,000 as a term, because hopefully that house is going to be paid off. It's going to drop. The kids are going to be out of the house after 20, 30 years. They don't need all that coverage. And do the rest of it in an IUL, right? Something that's permanently going to be there, that's going to take care of final expense stuff down the road if they need it, something they can borrow from, something that's going to give them cash value. And that's still going to fit in their price budget, right? Because like I said, a lot of people go with term because it's going to give you that most kind of bang for your buck, right? You're going to get the biggest kind of benefit based off of what you're paying in. And then the last example, 50-year-old male, no debt, large income, wife, right? A lot of agents, when they see that age and that there's no debt, are going to go straight to a final expense, right? Because they're a little bit less inexpensive. They're going to cover what they need. But one thing, and this is why I said finding out more information is good, large income, right? Maybe they do want to turn something into an annuity and have life insurance at the same time and take care, like, take advantage of those tax benefits, and you go with an IUL instead, right? There's just different options there that you're never going to find out if you're not getting that information. And, some of you might be surprised, some of you might not be. When I talk to a lot of different agents, and even myself, before I started kind of specializing in this stuff, we don't get a lot of information. And when I ask questions of, how much do they make? What's their spouse do? They don't have answers, right? They're just like, oh, I just was thinking we need a term, or we just need this, right? So getting that information is going to be really good, and going through it and finding out what's going on. Because the other thing is, like I talked about, is you're going to have clients who are going to have different needs throughout different stages of their life. And they're going to be coming to you because you set yourself up as a professional who really took care of them, which most of you already know and do, right? But it's going to be another option because life insurance, especially as you're getting into non-guaranteed issue, like I talked about, is going to be one of those sticky products. It's going to be there because most people don't want to go out and do the medical stuff again. They don't want to do all that. It's going to keep those clients with you as far as retention. And then if you offer other lines of insurance, if that's something you're into, as they go throughout the different stages in their life, there's going to be other products that you're going to be able to pivot to, that you're going to be able to offer them. And it's just going to kind of keep everything, nice and easy and moving forward. And to be honest, terms are great, right? I love them. But it's also something that could, like I said, be bundled with the universal life, or that might lead to one later. It could lead to hybrids. It could lead to all these different things like we were just talking about. That's going to open the door. So even if all you get is a term, great, right? Just make sure that you're having those other conversations, getting that other information, because it's going to set you up for success later, whether that's with other life policies or getting into other arenas and pushing it depending on the time of year and what you really focus on, right? Some people, all they do is med subs and med advantage, right? And it's a good thing to have those life options, because when you talk to those agents who do just MedSup and Med Advantage, right, they're getting those questions and they're having to funnel all that out to a different agent, right? When life insurance is really simple and easy. It's a great thing you can offer, and you don't have to turn those clients away from you. So that's just something to keep in mind if you're kind of toying with the idea of jumping into it. Um, but like I said, all this is kind of keeping pretty high level. I mean, we can get into the weeds on universal life, IULs, hybrids, and different webinars, or if you have any specific questions when we call you guys here, because we always do our follow-up calls. Or if you don't want to wait, you can give us a call at 800-672-7202, or feel free to email us, right? We want to make sure that we're setting you guys up for success. We want to make sure that we're offering the right stuff and that it's really going to help you out, because making sure you have the knowledge and the right products to be able to go out there and close those sales is what we're all looking for, right? No one wants to work for free. And if you're really good at something, you should never do it for free. So make sure that you're having those conversations with us, um, you know, and just get that knowledge, right? There's so much flexibility with some of these products and things that, a lot of agents will sell IUL, but they won't jump into some of that more complex stuff because they're worried that they're going to build it wrong or something's going to happen and they're going to have a disgruntled client. And the truth is, once you start doing it, it's not that hard to do. And until it's not hard to do, we're here to help you guys out, right? So I just want to say thank you to everybody for being here. There was a few questions. We'll be reaching out to you guys because they're pretty specific, but we'll jump into that. And I wish everybody a great day. Thank you.